Welcome to the winter edition of the 2023 Mortgage and Real Estate Reviews. Let's really start to dive into what we expect to see in the final portion of 2023 and for the following year. It's really important that you start to dive into some of your own individual reviews, making sure you have home and life insurance, how that works for your family. If your home is in a flood zone, of course, you need to review your insurance every year. Look at your individual mortgage. Is it time that we can get rid of your individual mortgage insurance? On your monthly mortgage statements, you get an escrow breakdown. It tells you how much is being collected every month from your payment to pay your property taxes and your home insurance. You can find your property taxes directly in your county. Washington State, we pay property taxes in October and April every year. So you'll see if you're looking at your monthly mortgage statements, between those months, your escrow balance will decrease because your 6 months of property taxes are being paid. Finally, your hazard insurance, which is your home insurance, that's really the insurance that covers you in case of fire or flood. You always want to meet with your insurance agent every year and look over your home insurance. How much is your home covered? What would happen if there's a wildfire in your area? What would happen if your spouse lost their wedding rings? Do you have that covered? Those are things you really should be talking about annually and just doing those deep dives. What's happening with current mortgage rates? Well, interest rates are finally coming down. They hit their peak over the summer where they were the highest that we have seen in a long time. So we finally are seeing mortgage interest rates coming down. When inflation starts to cool down, we start to see gasoline prices, food prices, utility costs coming down, any of those individual things that we see coming down. That means inflation is cooling. And when we finally see that cool down happen, we usually start to see that roll into mortgage rates. So as the year progresses, I do think we're going to continue to see mortgage interest rates slowly move down. Refinancing activity is actually up, and that's because credit cards and personal debt is really high right now. So a lot of people are utilizing the equity in their houses and doing cash out refinances to reduce their monthly outgoing expenses. When you list a home today, you have to really look at what area of the city, what county, what part of the state, and what type of home that you're looking to sell. And that's really going to adjust how your neighborhood is selling. Knowing where the market is will really help you to identify what you want to do with your current property. Remember, even though we live in our houses, there's still an investment for us for the future. Look at a 63-year average. Home prices have been going up about 4.5 during 2020, 2021, 2022. We saw skyrocketing numbers because we saw the demand being so high. When interest rates are extremely low, we're going to see home prices shoot through the roof. In a really healthy market, it's a great thing if interest rates are actually between a 5 and a 6%. If interest rates go down into the fours and lower, it's just too much of a decrease, and that's going to increase how many buyers are in the economy, and that is going to skyrocket home values. Home values going up are always an awesome thing. We don't want to see them go up way too fast because at some point you might need to replace your home versus in a healthy market. We're seeing interest rates in a healthy spot. We're seeing home prices go up in a healthy range. That is a good balanced market. And believe it or not, as homeowners, we do want to see healthy because anytime we're going to see property taxes, home insurance, all of those things increase since we don't want to pay extra, right? So what we're seeing in Washington State is in 2022, average homes were selling for about 588,000. That dipped in January 2023 when we started to see interest rates moving up. But as you can see, it didn't actually slow things down. If we look year over year, even though interest rates were in the 8% just a month ago, home values were still climbing. We're still in a very healthy market. Home values are not increasing as fast. And that's a good thing. Interest rates are coming down. I do suspect when interest rates start to come down into the sixes, I think we're going to see home prices move up a lot quicker than we normally would. Here's the impact that we're seeing on inflation. So again, I told you that inflation is coming down. So there are a lot of reports that are put out every single month that show us comparing month to month and month to year over year, how things are affecting us as an American household. We are starting to see the overall cost of goods come down as well. But we are starting to see the impact of inflation being too high, and that's starting to show in recessionary markets. In a recession, we typically always see home prices actually increase because we see mortgage interest rates decrease following a recession. During a recession, this is where it's really good to use equity on your house to kind of help create a padded landing spot for you, but also to help you alleviate any of the other debts that you have every month that you're paying. So here's what we're seeing. The first photo here is the BLS jobs reports. What they look at is in total, how are we seeing increase in hourly pay? So we are seeing that people are getting paid more per hour, but we're actually seeing that a lot of people are working less hours per week. And so that's a trigger that we want to watch for entering into recessions. That decline of half hour decline in a big economy like the US, that's equivalent to about 2 million jobs being lost in the economy. So that is going to make an immediate impact on how people are spending money out in the economy. When do we expect the feds to start cutting the rate hikes that they did? Because how the feds work is that they impose rate increases, and that helps to slow down how we're spending money in the economy. But when they push it a little too hard, what happens is exactly what we're seeing with the job losses. So now we expect them to start applying the brakes and slowing down the rate hikes that they did. So let's talk about housing, because now I know that you're kind of scared about job losses, but again, housing has always come out on top. So here's what we've seen for the housing market trends from 19 to 23. In 19, and we saw just average normal year over year appreciation, but 20, 21, those all explode. In 23, again, we're still seeing house prices coming up. So if we look at the homes that are on the market, 47% of homes are equity rich. What does that mean? It means that between what you owe on your loan versus what the home's worth, out of all the homes that are out in the US right now, about 47% of them have a lot of equity in there. And so they can utilize that equity to be able to help either pay off debt or take out a home equity line of credit or look at other creative ways to be able to take pressure off of themselves. Here's what I'm seeing in these four major markets. So in Spokane County, I'm expecting homes to continue to appreciate about 4.5% in the next year. Over 5 years, it's going to be a 21% increase. So if you bought a house today at $422,000 in 5 years, it's going to be worth about $510,000. So that's an $88,000 increase in Kitsap County. We're looking at over 5 years, about 26% increase. Snohomish, I'm expecting almost 29% over 5 years. And Pierce County is going to be about 25% over 5 years. That the news always tries to terrify us on what we're seeing out there. So CBS News did this whole article about foreclosure spike. And this is a quote directly from it, where they said Americans are losing their homes at a faster rate this year as banks make up for lost time, up to 22% from the same period last year. So during COVID, there was no foreclosures. Economy that we're seeing with really low inventory. And I continue to see it increasing over time a little bit. But again, as you can see in the chart, during COVID, we had a 0% foreclosure rate. So that's got to return to somewhere in the normal range. This is another chart just to break down that data, because I love data and I'm such a data nerd. I love seeing the history of values. So on the chart on the right with all the green, that's how much from 1942 to today, till 2022, how much each year homes increased in value. So you can see that very rarely did we not have increases. We had 1 year with 0 increase. That was 1950. We had one more year with a 0 increase in 1991. 1990 was 1% decrease. During the '08 bubble, that's the only time that we really saw homes deep value in pricing. And because of that was mainly we had so many houses on the market. We had really lax lending standards back then, and anybody could qualify for a mortgage. So if you look at the chart on the left, in '07, we had over 4 million homes for sale in the market. And if you look at today, we have about 1.08 million homes available. So the quantity of homes for sale has drastically come down, and that's going to continue to be the normal pattern. I don't see builders building huge, fast communities like they used to back before the '08 burst. And lending, it is so hard to qualify somebody for a mortgage that they really can't pay. So I don't see those two big things coming into play again. So value-wise, I think we're going to continue to go up. Here's my thoughts. Absolutely foresee a recession. I do truly believe home prices are going to continue to increase. I really believe mortgage interest rates are going to come down. And smart homeowners, I think right now, if they're struggling on their outgoing expenses versus the income, or they're worried about a recession or any of those moves, I think the really smart ones are reeling in their expenses and looking at cash out refinances. They're looking at lowering that interest rate when there's an opportunity. They're looking at taking out cash to be able to deal with the other debts that are holding over their heads. They're looking at shorter loan terms. How can they do that? Or changing their loan types, and especially removing private mortgage insurance is a big one. Debt management is a huge component of what I really push on all of my clients, like I think it's really important to start really understanding where you're spending your money. What is those interest rates that you're really paying every month? What kind of debts can you start to pay down? How can you consolidate those? How can you use equity to help you get there? How can you renegotiate your terms for a better term later? And then after you're done all of these steps and moves to improve your finances, how can you keep your budget and your debt consigned with each other so that way you are in a positive movement every single in because of everything happening with inflation in America, we're seeing that there's less savings and there's a lot more debt. So during the COVID fluctuation, we got some crazy checks that we normally would not have. A lot of people actually invested that money, so they had some savings, but it's just been quickly dwindling down, and we're losing more and more out of our savings accounts. And our credit cards have really started to skyrocket. Our average car payments are $800, which is double in just 3 years. So we really need to look at what we're spending our money on and how we can start to use our equity to alleviate that stress. I know the thought of giving up a 3% interest rate makes you terrified, but what we need to look at is, do you really have a 3% rate? When we take all of your debts in your mortgage, your Visa, your MasterCard, maybe you have a Macy's or a Nordstrom's card, and we combine all of those debts together, that blended rate is a lot higher than a 3% interest rate. So these are just some ways I've been helping clients to look at what their outgoing expenses are, what they've been paying, and how can we start to use any of the equity from the house to alleviate that, taking you from maybe 1,500 going out of pocket down to 200 going out of pocket. So that way you can breathe a little bit better in your monthly expenses. We need to work on your financial planning. We want to make sure that your mortgage term about it. And let's figure out how to strengthen your financial position so that you're in a really great spot for the future.